Are you getting ready to dive into your first home purchase? If so, it may help to learn the lingo when discussing mortgages. Obtaining a mortgage is a vital step in purchasing your first home, and there are multiple factors for choosing the most appropriate one. While the myriad of financing options available for first-time homebuyers can seem overwhelming, taking the time to research the basics of property financing can save you a significant amount of time and cash. There are a number of home loans to choose from when you purchase a home, so it's crucial to fully understand the advantages and disadvantages of each type before you make a decision. Depending on the type of mortgage you choose, you'll have different requirements that influence your rate, the length of the loan, and your lender. Selecting the right mortgage for your situation can lower your down payment and decrease the overall interest payment over the life of your loan. And with that said, here are the different types of home loans for a home purchase. Stay tuned. Fixed rate mortgage. A fixed-rate mortgage has the same interest rate and principal interest payment throughout the loan duration. Moreover, the amount you pay per month may fluctuate because of changes in property tax and insurance rates. But for the most part, fixed-rate mortgages provide you with a very predictable monthly payment. This type of mortgage might be a better choice for you if you're currently living in your forever home. A fixed interest rate offers you a better idea of how much you'll pay each month for your mortgage payment, which can assist your budget and plan for the long term. Notably, you may want to avoid fixed-rate mortgages if interest rates in your area are high. Unless you refinance, once you lock in, you're stuck with your interest rate for the duration of your mortgage. If rates are high and you lock in, you could overpay thousands of dollars in interest. Consult a local real estate agent or home loan expert to learn more about how market interest rates are trending. Adjustable rate mortgage. Unlike fixed-rate mortgages, adjustable-rate mortgages, ARM, provide mortgage interest rates usually lower than you'd get with a fixed-rate mortgage for a while, such as 5 or 10 years, rather than the life of a loan. However, after that, your interest rates and monthly payments will adjust, typically once a year, roughly corresponding to current interest rates. So if interest rates increase, so do your monthly payments. If they plummet, you'll pay less on mortgage payments. This mortgage is suitable for homebuyers with lower credit scores and are best suited for an adjustable rate mortgage. Since individuals with poor credit often can't get reasonable rates on fixed-rate loans, an adjustable rate mortgage can nudge those interest rates down enough to put homeownerships within easier reach. And also, these home loans are fantastic for people who plan to move and sell their homes before their fixed-rate period is up and their rates start vacillating. Still, the monthly payment can fluctuate. Balloon mortgage. As you would for any other type of mortgage for the first 5 years or so, with a balloon mortgage, you'll make monthly payments. At the end of that initial payment period, you'll pay off the total amount you still owe in one lump sum. Balloon mortgages come with low interest rates, but they're risky. You might like a balloon mortgage if you expect to move out of your home or refinance prior to the initial payment period. This way, you'll benefit from the low rate without paying a ton of money all at once later. You may also prefer a balloon mortgage if you expect to receive a lot of money in the time between getting the mortgage and paying off the total amount. But this mindset can be dangerous, especially if the money you're expecting doesn't come through. Balloon mortgages are risky for both the buyer and lender, so finding a lender that offers one may be difficult. Government-insured loans. The U.S. government isn't a mortgage lender, yet it does play a role in assisting more citizens to become homeowners. 3 government agencies back mortgages: the U.S. Department of Agriculture, USDA Loans, the Federal Housing Administration, FHA Loans, and the U.S. Department of Veteran Affairs, VA Loans. USDA Loans. USDA loans aid moderate to low-income borrowers purchase homes in rural areas. To qualify, you have to buy a home in the USDA-eligible area and meet certain income limits. Some USDA loans don't require a down payment for eligible borrowers with low incomes. There are extra fees, though, such as upfront fee of 1% of the loan amount, which can typically be financed with a loan, and an annual fee. FHA Loans. Backed by the FHA, these type of home loans make homeownership possible for borrowers who don't have a large down payment saved up or don't have pristine credit. Borrowers require a minimum FICO score of 580 to get the FHA maximum of 96.5% financing with a 3.5% down payment, yet a score of 500 is accepted if you put at least 10% down. These loans need 2 mortgage insurance premiums. One is paid up front and the other is paid annually for the life of the loan if you put less than 10% down, which can raise the overall cost of your mortgage. Finally, with an FHA loan, the home seller can contribute to closing costs. VA Loans. VA loans offer flexible, low-interest mortgages for members of the U.S. military, active duty, or veterans and their families. These loans don't require a down payment or mortgage insurance, and closing costs are generally capped and may be paid by the seller. A funding fee gets charged on VA loans as a percentage of the loan amount to help offset the program's cost to taxpayers. This fee and other closing costs can be rolled into most VA loans or paid upfront at closing. Most lenders give the lowest rate possible on VA loans, and some are willing to accept lower credit scores. Conventional mortgages. The government doesn't back conventional mortgages. You'll require higher income and credit score to qualify for them, but the interest rates usually are lower, which implies your mortgage will cost less over the lifetime of your loan. These loans often require a down payment of at least 5% of the home's purchase price. If your down payment is under 20%, you'll also have to pay private mortgage insurance (PMI) fee on top of your monthly payments until you've paid 20% of the selling price. Qualifying for these loans can be tricky, but the upside is that if you do qualify, the lower interest rate and larger down payment means your mortgage payments will be lower every month. You may also be able to choose whether to pay off your loan over 15, 20, 25, or 30 years. All of that can be friendly to your budget. Conventional mortgages can be used for most kinds of property, including vacation homes, condos, and rental properties. Jumbo mortgage. A jumbo mortgage, also referred to as a non-conforming mortgage, is a type of conventional loan. To borrow more than the FHA borrowing limit, you'll require a jumbo mortgage. This year, the limit is $647,200 in most parts of the U.S. In areas with higher costs of living, such as Guam, Alaska, Hawaii, and the U.S. Virgin Islands, the limit has been raised to $970,800. A jumbo mortgage is for an amount higher than these limits. Eligibility requirements for jumbo mortgages are a bit stricter than those for conforming mortgages because the lenders are taking a significant risk by lending you more money. Each lender has its own requirements for non-conforming mortgages. Still, you'll likely require a high credit score, low debt-to-income ratio, and a more significant down payment than you would for a conforming mortgage. Construction loan. You might require a construction loan if you build a house and need financing to cover permits, labor, and supplies. Construction loans are short-term loans, usually for 1 year, that carry higher interest rates than regular mortgages. You may opt to pay off your loan once construction is completed or roll it into a standard mortgage. If you want to purchase a home and make considerable changes to it, you can apply for a renovation loan. The money you borrow for renovations will be rolled into your mortgage. Which type of home loans for your home purchase would you opt for? Let us know in the comment section. We hope you enjoyed our video, and be sure to give us a thumbs up and share it. And also, subscribe to our channel and be sure to ring the notification to get notified when we upload new and interesting content. And until next time, goodbye.